All right, let's get right into it. Today, we're taking a deep dive into the IRC Section 30D New Clean Vehicle Credit. And for tax professionals, you know this has become a real minefield. It's not just about getting a client a credit anymore. It's about navigating these crazy procedural traps, especially now that a new, hard deadline is staring us down. Because if you get this wrong, what your client thought was a sweet discount can flip into a truly devastating tax bill.
We're talking about a lot of money here, up to $7,500 for every single qualifying vehicle. That's a huge incentive for sure. But a recent and, let's be honest, pretty abrupt change in the law has turned this whole thing into a high-pressure scramble against a ticking clock. You see, the Inflation Reduction Act, the IRA, originally gave us this nice long runway for the credit, all the way out to the end of 2032. But then along came the One Big Beautiful Bill Act, or OBBBA, and it just slammed that window shut. The credit now completely terminates on September 30, 2025. This timeline getting squeezed so drastically is the pressure point that just magnifies every single risk we're about to talk about. So here's our game plan. First, we'll tackle that new 2025 sunset date and what's at stake. Then, we'll break down the Modified Adjusted Gross Income, or MAGI, Lookback. From there, we'll hit the point of sale transfer, which you'll see leads directly into the biggest danger here, the $7,500 recapture trap. Then we'll get into the weeds with special filing status rules and wrap it all up with a solid compliance checklist you can actually use.
Okay, first up, that 2025 sunset. With this new immovable deadline, the legal definition of placed in service is no longer some trivial detail. It's become the absolute make or break point for your client's eligibility.
And let's be crystal clear on what the law says. The OBBBA is explicit. No credit for any vehicle acquired after September 30th, 2025. Now, in the IRS's world, acquired means one thing and one thing only: the day the taxpayer takes physical possession of the car. It's not when they sign the contract, not when they put down a deposit. If your client drives that car off the lot on October 1st, 2025, even by a few hours, the credit is gone. Period.
All right, on to Section 2. Let's talk about the modified AGI limitation and this thing called the Lookback Provision. You know, Congress designed this to be a helpful safe harbor for taxpayers, but as you're about to see, it's a tool that is now loaded with hidden dangers.
Now check out these numbers. Under Internal Revenue Code Section 30D F10B, these are the hard MAGI thresholds. $300,000 for married filing jointly, $225K for head of household, and $150K for everyone else. What's really crucial here is that these numbers are not indexed for inflation. They are set in stone.
So, what happens if your client's income is right on the edge? Well, this is where the lookback provision comes in, governed by IRC Section 30D F10A. The idea is that a taxpayer's eligibility is based on their MAGI for the year they actually put the vehicle in service. However, they can elect to use the MAGI from the year before instead. This means they get to use the lesser of the 2 years' income. It's a really powerful planning tool, right? It lets a client qualify based on last year's income, even if a big bonus or a capital gain pushes them over the line this year.
Let's move on to the point of sale transfer. This provision, found in IRC Section 30DG, was really meant to make things easier for the taxpayer. But, and this is a huge but, this convenience is exactly what arms the recapture trap we've been leading up to.
So the mechanism itself is pretty simple. A taxpayer can choose to transfer their future tax credit right to the dealer. The dealer then gives them that money, up to $7,500, as an immediate discount, right there on the spot. It's like cash off the top. The catch? The dealer has to be properly registered with the IRS's Energy Credits online portal for any of this to be legit.
And that brings us right to the heart of the matter. The biggest danger, the ultimate threat in this whole system, the recapture penalty. It's codified in IRC Section 30D G10, and this is the exact spot where a client's upfront savings can morph into a massive, unexpected tax bill.
I mean, this quote from the source material just says it all. It's not just a penalty, it's called the most devastating consequence in this whole part of the tax code. And the reason it's so devastating is because it totally blindsides the taxpayer.
This slide perfectly illustrates that disconnect. Your client walks out of the dealership feeling great, thinking they just scored a fantastic $7,500 discount. But then, when they file their taxes, if it turns out they failed the MAGI test, the reality is their tax bill on Form 1040 is now $7,500 higher. That discount was never a discount. It was basically a loan from the U.S. Treasury, and the bill has just come due.
So, here's the legal hammer.
The mechanism under Section 30D G10 is a direct increase to their tax liability for the year they got the car. If the taxpayer's MAGI for both the current year and the look-back years over the limit, they were never eligible in the first place. And the IRS isn't going back to the dealer for that money. They're coming straight to your client to collect that $7,500.
Okay, now for Section 5. As if it wasn't complicated enough, things get even crazier when you dig into the special rules under Treasury Regulation 26 CFR Section 1.30D-4. This is especially true for taxpayers whose filing status changes from the look-back year to the purchase year. These are the little details that can absolutely trap an unwary practitioner.
Okay, look at this wild example. It's what's known as the divorce trap. In 2024, you have a couple filing jointly. Their MAGI is $290,000, which is under the $300K limit, so for 2024, they're good. But then they get divorced. In 2025, one of them is now filing single, and their MAGI is $160,000. Well, that's over the $150K limit for a single filer. So what happens? In this super counterintuitive situation, the taxpayer can still qualify. Because their 2025 income makes them ineligible, they can elect to use their 2024 status, where they were eligible. So they get the credit in 2025 based entirely on their prior joint filing status. Crazy, right?
So what about fiduciaries? What happens if you have a trust or an estate that's brand new, formed in 2025, and it buys a qualifying vehicle? This is another one of those specific traps that's really easy to miss. And here's the rule, and it is a harsh one. The regulations state that for any year a trust or estate did not exist, it is legally treated as having a MAGI above the threshold. So for a non-grantor trust formed in January 2025, that 2024 look-back is completely off the table. It didn't exist. Its eligibility depends entirely, 100%, on its 2025 MAGI staying below that $150,000 limit.
All right, let's wrap this all up. Let's boil everything we've discussed down into an actionable compliance checklist. The key intel you need to mitigate all these risks for your clients.
First, you absolutely must confirm that placed-in service date will be on or before September 30, 2025. Then, you've got to scrutinize and project MAGI for both the current and the preceding tax years, and think through any filing status changes between those 2 years. Make sure the dealer is actually registered on the IRS ECO portal. And this is a big one. You have to advise your clients that when they're at the dealership attesting to their MAGI, they are doing so under penalty of perjury. And finally, don't forget, even if they transfer the credit, they still have to file Form 8936 and its schedules to reconcile everything.
Because at the end of the day, all of these complex rules and regulations, they all come down to this one form, Form 8936. The IRS demands strict, literal adherence, and this is the piece of paper where your client's eligibility is either proven or it's disproven.
So I'll leave you with this question for your own practice. With that September 30th, 2025 deadline now locked in stone, have you really stress-tested your client's eligibility against a surprise at the end of the year? Because a big capital gain or an unexpected bonus in December could be the very thing that triggers a $7,500 recapture on a car they were so happy to buy way back in June.